Good morning, everyone. Welcome to the Prosperity Through Multifamily Real Estate Investing podcast. I am your host, Real Estate Cody, and with me, as always, is the coffee connoisseur himself, Mr. Brian Alfaro. What's up, bud?
Cody, I'm back.
You are back. I know you went MIA last week. I was a little bit lost.
Lonely?
I was, man. Dude, a pilot cannot fly without his co-pilot.
That's right.
I know our guest today knows all
Bill
about
knows
that.
Yeah. No, it's awesome to be back.
It's good to have you back, man. But it's all for good reason, man. We've been busy. We've had a lot of great things going on. So exciting way to start 2022, getting this latest acquisition wrapped up, getting into a next one right after that. So
congrats.
Yeah, thanks, man. Thanks. But most excited about today's guest, friend of the show, three-time appearance on the show today, the one and only coach, mentor, real estate investor himself, Mr. Bill Ham. What's up, my friend? Welcome back.
How's it going? Yeah, thanks for the third time back. It's my favorite podcast, man.
Just sweet talking us, Bill.
Yeah, man. It's always great to have you on the show, man. Really appreciate that opportunity to speak with you. And for the listeners who are just tuning in for the first time, if you have not heard of Mr. Bill Ham, go check out episode 14 and 57. And coincidentally, Bill, looking at the timeline, your first appearance was in kind of like end of 2020. Your second appearance was literally almost a year to date from this episode back in 2021. And then here we go, starting 2022. All right. So awesome, man. Glad to have you back here. And again, as referenced in the brief intro, you are a best-selling author. And today we're going to be talking about the latest book, Real Estate Raw. Really excited to dive into that. For those who are on the screen, check that out. Available on Amazon and where else, Bill?
Kindle.
I'm sorry?
Kindle. Amazon and Kindle.
Amazon and Kindle. Awesome. Great book. So looking forward to diving in there. So what's been going on in your world, Bill?
Yeah, besides writing those two books, just trying to make a living in real estate, keeping up with the markets and what's going on. And, it's ups and downs. There's opportunities. There's challenges, all the fun stuff. It's an interesting market cycle right now. But that's pretty much what I've been up to, either running the business or teaching it, one of the two.
Yeah, I think that's a very polite way to put it, is that it's an interesting market cycle. It's
interesting.
It is very interesting. And it's funny because we've asked this question the last two episodes, right? Like, what's your insights as to the market dynamics, 2020, 2021? But I feel like it's a relevant question again right now because the market is moving so fast, and we just have this very dynamic market cycle right now. Tell us, man, what is your insights or perspective on the current market environment that we're seeing?
How long is this show? I don't know if we have time. No. I think that we are headed into a correction is my number one answer. Not a crash, but a correction. I think that I'm a big believer in market cycles. It's something I teach and talk a lot about. It's in the book. And I think we all need to be sort of students of market cycles, not to live by them, but to just sort of generally understand what's going on. And so we, per all of the indicators, are about to go into a cooling off window. And that means lots of different things: cooling off in price, lengthening in time of ownership before a sale or a refinance, things like that. So I think where the timeframes have been very compressed over the last 3-4 years, they're going to start to decompress. So what was once a return in 18 months, a refi in 24 months, things of that nature, you're going to extend that out 3 years, 4 years, things of that nature. So I think that's one of the cycles we're going to see, is a lengthening of time frames. And one of the major reasons that I say that is because the returns are starting to get pretty low in a lot of the deals out there, meaning somebody somewhere is going to have to actually hold on to that asset, be a real landlord, actually raise the rents, actually operate the property, and actually make that thing make some returns. And we've not seen a lot of that. We've seen the tide floating all boats is what we've seen. You buy the property, you don't raise the rent, you don't do any value add, you don't really make any more cash flow. Somebody comes along and pays you 30% more than you paid. They don't really raise the rents. They don't really do anything. And they sell it for 30% more. And it's just market speculation driving that. That lasts until it doesn't. And when people kind of sober up and go, wait a minute, somebody's actually going to have to go over here and collect the rent, raise the rent, and produce some real returns, that's where the tide can stop rising, and people that are not skilled operators can find themselves in a different world. But that's sort of the back of the napkin prediction, cooling off window, but that'll also provide a lot of opportunity,
which we are very much looking forward to if that opportunity does come along. But Bill, I'm gonna kindly just kind of pick at this a little bit here because I think people hearing that message for the first time, we've been hearing something kind of along the lines over the past, really several years. I mean, people have been saying, hey, we're at the top since 2017, 2018, and whatever. And then now you have this dynamic post-pandemic where we have this massive amount of liquidity that's in the marketplace. We've been in this incredibly low interest rate environment for a long period of time. And then, that has also kind of continue to compress the cap rates and such. And so, as you mentioned, yields are tighter, but people are still benefiting from accelerated appreciation.
Agreed.
So it's with the amount of liquidity that's in the marketplace and the demand, and particularly the housing supply, demand, and balance, kind of talk us a little bit more through that thesis then, because it's kind of hard to see a circumstance where things cool off.
Yeah, agreed. And that is one of the big problems in today's market. For every argument, there's a complete and totally opposite argument that's just as logical and just as equal and completely unravels everything you just said and totally makes everything else opposite. It's tough. It's like this is one of those times when the coin toss has landed straight on the edge of the coin. It didn't land on heads or tails. It's right on the edge, and we're going, well, which is it? And it's tough, and so we're kind of balancing on that razor's edge. But I believe that we're going to see a cooling off for several reasons. But we could not see a cooling off because of the things you just mentioned, inflation, wealth preservation, not wealth creation, money moving from other countries into American assets where they're not really interested in cash flow. They're really more interested in protecting their capital and things like that. Yes, all those are concepts that could come up and could certainly continue to buoy the market. It could. But the one thing I always kind of ask everybody, or I don't ask, but I'm saying, well, then the real question that we have to ask when we're looking at is, are we looking at a market shift or a paradigm shift? Because it's one or the other and it's coming. So either we are going to have a cooling off window where multifamily starts to produce higher returns, or we are moving into a world where we no longer look at the metrics of multifamily and value multifamily through the metric of cash flow. Which is it? Well, the first would be a market shift. The second would be a complete paradigm shift to where we just decide multifamily no longer needs to cash flow, and we're okay with that, because that's what we're saying. If we take today's trends and follow them all the way to fruition, if we see a trending cap rate, compression, a trend of compression, okay, fine. So cap rates are going to compress to what? 0? -1? I mean, that's the pattern, isn't it? Well, I mean, if, a 0 cap rate world, I mean, I guess that could exist. I don't think that will exist, but it could. And that's kind of what we're saying. So either if the pattern continues on and it doesn't shift, then we're all going to be buying real estate without ever looking at cash flow again. And if not, then we're looking at a market cycle where we're going to have to kind of hold on to these things and bring some returns back into them. It could be either or. In that concept of just assets being traded without cash flow, that's not a crazy concept. Is it crazy in America? I hope so. Not crazy in a lot of other countries around the planet where they really don't produce a lot of cash flow. Our neighbor to the north, Canada, Japan, a lot of the Asian countries, they don't really see a lot of positive cash flow, but yet values still go up and they still trade real estate. So it's not to say that's an impossible concept. I think Americans are probably going to be a little more on the entrepreneurial side, probably want a little more cash flow. We'll see. I don't know, but it's possible that we could go to that model. That would be a paradigm shift. So I don't know. I think that we're going to see a cooling off and we'll see cash flow, not a complete shift away from cash flow, my opinion.
Brian, what do you think about that market shift versus paradigm shift? That's a really good reflection point.
And that's a golden nugget. We talk about this all the time, but phrasing it in that way is awesome, Bill. It's getting your investors, both active partners and passive partners, to sort of wrap their mind around that. Because if you've been investing, say, passively in real estate for decade, even 4 or 5 years, people are chasing these 8, 9, 10% cash on cash returns. You're starting to see thinner margins. You're starting to see these questionable pref models and waterfall structures, just people getting creative with their deals. Yep. And the average sort of a sophisticated investor is going to have a hard time if there is a paradigm shift saying like, hey, you're going to give us $50,000 for a deal, and it's just for wealth preservation. It's for tax benefits. It's for equity appreciation. It's for upside, but there's very, very little cash flow. And a lot of people are going to have a hard time with that. So it is an interesting topic. If we go back to the cash flow model, that's great too, because you want to have some dry powder and buy a bunch of stuff, right? But if not, I think there's going to be this cycle, this mindset shift that's going to have to happen. It's going to take a lot of people some time, and it might kick some people out of the market too.
I think there's going to be a changing of the guard. Some people are going to get hurt, and that's going to create some opportunity. And that's financial Darwinism. It just is, it's just the way it works. And some make it, some don't. Those who have over speculated, and been too aggressive are usually the first punished, So it's just the way the world works. And I don't wish anybody ill, but I'm right here waiting for some good deals when they show up. I'll be ready to buy them. But I think that we're not, that maybe over the next 10, 20, 30, 50 years, we would be moving more towards a no cash flow model. Over the next market cycle being under 10 years, I don't see that happening, because the market has gotten so inflated, not due to any of those other metrics. See, and that's the one thing that we're talking about is the market's all inflated, right? So the market is inflated as it is because everybody's trying to protect their money, not make money. That's not true. So the market's super inflated because all of the foreign money from all around the world just flooded into America, and that's the reason. Nope. The reason that the market has gotten so inflated is because of syndication, is because of the concept of syndication. It's a great concept. We teach it, and students went out and did exactly what we taught them to do, which was syndicate. And that has kind of created the market, right? Well, syndication is about producing cash flow. And so if cash flow got the market to where it is, and cash flow won't sustain the market where it is, then the market's either going to shift or we're just not going to worry about cash flow. I'm betting we're going to see a shift prior, because what got us here won't keep us here.
So, Bill, I want to kind of focus on the paradigm shift part of this conversation, because I know you provide a lot of great content, a lot of great education across your media, your platforms and whatnot. Mm-hmm. And you teach this, right, where your wealth is not built in cash flow. It's built in the appreciation and equity from real estate. And please correct me if I have this wrong. Yeah. Right. So I think what, at least in my observation, would be, like you said, with the amount of liquidity that's in the marketplace, investors, and you're talking about big shops, you're talking about the institutional buyers, the family offices that are chasing the multifamily space. They're looking for the opportunity to park that cash in a resistant, resilient asset like multifamily, but for that preservation, and, from our perspective, being at the retail level, if you put this into perspective, if you think about the cash flow model and how many, let's say, units or how many acquisitions would you have to do to really generate enough significant cash flow to sustain whatever level of passive income you need, that you're talking about a pretty sizable portfolio you would have to build, right? But then what you talk about in your conveyor belt model, which I hope you kind of reiterate for us again, is, as assets appreciate, and once we start the conveyor belt, that's where your real wealth is built. So that's where I feel like, I'm not disagreeing with you by any means, but no, please that's do. Where I love disagreement. Well, it's just like, it's interesting because what we're seeing right now is right. Cash flow is not as important as, hey, what's the equity multiple? What's my overall return in the next 3 to 5 years? And that's kind of the conversation that we're hearing quite frequently, Brian. I mean, would you agree with that?
100%. But like Bill's saying, I mean, there's the coin standing on the middle. So I agree. A lot of investors are IRR driven, and we're seeing equity multiple different conversations, and then they want to know about the cost segregation study, which is going to start to step down in next year. It goes from 100% to 80%. So that's going to probably have another small impact on multifamily, I think. But these are all good points. I wish I had the crystal ball, but I
would love for the market to go that route. Screw cash flow and let's never worry about it again, because now everything's a good deal. You don't have to pull out a calculator ever again. You just point at a building and go, "Oh, that's a good deal."
That's Grant Cardone.
And that one too. There's no more deal analysis, is there? Everybody can buy real estate because it's all just going to go up in value, and we don't have to worry about analysis and cash flow and all this kind of garbage. And so we as a syndicate, as music syndicators, you all, we can just go out and syndicate any whole thing then, because we don't have to worry about cash flow anymore. Great idea. I love it. Let's do that. I'll take a bunch of that. Now, if that's what everybody wants to do, they just want to get tax write-offs and appreciation, cool with me. I could care less. I don't care what the price of real estate is. I don't care what the values are. It doesn't matter to me. It matters that you care. It matters that the investor cares. And it matters that I can produce a product that you're interested in, that I can produce a product that you feel comfortable with, and that the returns are good for you. Then it's a good deal for me because it's your money I'm spending. So again, I don't really care what the price of real estate does. I just care whether the investors are making enough money to be attracted to it. And that's where I kind of start to say, yeah, there's a lot of other areas people can make money these days. And if we see some strength in other markets, it may be a competitive pull against the returns we see in real estate. Because a lot of times when I talk to people, like you're talking to people that are getting savvy, they're more onto the wealth preservation, the write-offs, the depreciation, all that. But, about 50% of the people I talk to go, yeah, but I can make that same amount of cash flow in the stock market asleep, and my 401k is making more cash flow than that. You know what I mean? So there's always an argument back and forth where I don't think there's enough investors that are going to just follow the wealth preservation and appreciation model to sustain the market where it is. I don't think. Could be wrong.
I don't think at the retail level. Well, I think what it's going to cause, it's going to cause a higher barrier to entry. Right. You're going to, people like us, Bill, people that are trying to do what we're doing, it's going to get harder to take people's $50,000 and $75,000 that are retail investors that are looking for cash flow to sustain their lifestyle. But what it's going to open the door to are more family office relationships, more institutional or quasi-institutional level type capital that are looking for. I mean, Cody, how many people did we talk to in California that are like, your guys are buying on 3 caps? I'll take it. They're looking for 3-4% cash on cash return because it's better than what they're getting in some of their other investments in their other markets. And they love multifamily. So I think it's going to cause that barrier to entry for like raising capital and getting into multifamily deals to be a lot higher for the newer retail investor and the people that are more experienced, that are already ahead of the curve. And it's the saying of the rich getting richer, right? It's the people that have been in the space for a long time are going to be even more successful.
Yeah, I agree with that comment. Yeah, we're probably definitely going to see some of that. Yeah. But way it goes. But I real estate is the way to go. It's the way to be. It always has been, and it always will be. And my only regret in life is not buying more of it. I mean, really. And over time, it always tends to work out to be the better model. So I think this is just a temporary blip in the market, and that people are always going to make money in real estate, whether it be cash flow, whether it be appreciation, depreciation, whatever. We're going to make money in real estate, and it may not be the American dream of just lying asleep on our couch, being just showered with rent checks and cash flow. Okay, maybe it won't be that model anymore. We'll all still make money in real estate. Real estate is absolutely the way to go. It's still what you want to earn. It's just going to, where I think it's going to be harder is for the fly-by-night gurus to sign up unwitting students into the business based on promises of get rich on cash flow next week. I think that's what's going to stop first. And I'm all for that. I think there's way too much nonsense information and nonsense sales pitches that get new investors misled about what real estate is. They collect a bunch of education fees from these people, railroad them into a bad program. And then the student thinks, well, real estate's not a good idea. That doesn't work. No, you just had the wrong teacher that just didn't have the information for you. And I think that a lot of that needs to stop. And I think a lot of that will stop. Or
they don't realize how much work it is.
That's again, why didn't somebody tell them? Yeah. Didn't they pay to be told the truth? Well, you would think, but that's my soapbox. I'll get off that. But
well, you're right, Bill. I mean, look, if you rewind, 11 years ago when I got in the industry, you didn't have all of these educational programs out there. You had maybe 1-2 big named programs, but really there was none. And then, like you said, with syndication becoming such a popular investment vertical, now it seems like everybody has an education program of some sort, a mentoring program of some sort. And although we obviously fundamentally believe in the power of real estate, we believe in the syndication model, it works.
Absolutely.
The barrier to entry right now is, in my opinion, probably the highest it's ever been for the newer investor. It is the most challenging time to enter into the space. And we don't want to discourage anybody from trying.
No,
but it takes work. But, I consider you like a fundamentalist, right? Your principles are just rooted in experience and going through multiple cycles. And you said this in our previous show, right? Mm-hmm. Eventually, just where we're at right now, just real estate just doesn't really make money because the fundamentals, we've deviated from the fundamentals. But although we're still seeing, right? We're still seeing just.
Well, and you won't for much longer. And I'll tell you why, because the one subject we hadn't hit on yet, debt. And it's the only subject that matters. All the rest of the things we've said are irrelevant if you don't factor in debt. And he with the gold always makes the rules, right? And lenders control the market. There's an old saying that a bull market does not die of old age. It's shot. Yeah. Well, that's exactly what's going on here, right? A bull real estate market isn't going to die of old age. The lenders are going to take it out back and shoot it. And they're going to do that by doing what? Raising the rates. Well, we know that's coming. All right. Number one, rates are already up. Fed's going to raise rates. Number two, the lenders are starting to tighten up on criteria. And that's where you'll start to see the market shift. You know, this is a lending cycle. And that's one of the big parts of where equity moves through cycles. In the first part of an up cycle, the equity slides over towards assets purchasing and investing. And then as we reach the top of a market cycle, all of that liquidity shifts away from long-term investments and moves into short-term debt. And so if you've noticed over the last 2 years, where did the most of the liquidity go to? Debt, to creating loans and funds and all this kind of stuff, right? So that's just part of the market cycle. And that cycles out as well. And the debt starts to cycle down. When the debt starts to cycle down, then your distressed assets are the first ones to take the hit because they're hard to fund with traditional debt. And that's what I remember back going through the post 08 recession, 2010, 2012, all that, when, you know, it was very difficult, easy to find a deal, deals everywhere. Get a loan, good luck, because nobody wanted to fund real estate. Well, now here we are in the complete opposite, right? Debt everywhere, no deals. And the debt will start to tighten up, which will reverse the model. Then we'll see more deals, and it's just cyclical over and over. And but watch your lenders. That's the big key. Watch the lending market. That's what we'll see shift, and all of the liquidity will be consumed in the next year or two, couple of years, several different ways. One, interest rates rising. Number two, the amount of liquidity that you have to put into a deal right now to couple it with debt. You know, to go and get an 80% loan to value and put down 20% is very difficult to come by that because the prices are so high. These lenders are asking 30 on, and Fannie Mae average 40% down payment to go with agency debt right now, 40% down payment. Well, if every transaction moves from 20% down to 40% down, there ain't gonna be much liquidity floating around for long. It'll be all in these real estate deals and that'll consume it. And that will equalize too. Everything, no tree grows to the sky. Everything always equalizes. You do have to have kind of a crystal ball, but you look forward by looking backwards, you know, and it's pretty predictable.
Well, this is such a great segue, Bill. And I'm glad you brought this up. And I'm going to reference the last conversation we had a year ago in episode 57, I believe. We mentioned that through this recovery, you know, we're going to see this K-shaped recovery, right? Where the core assets, core plus assets, we're really going to continue to appreciate. Your older product, your true value add opportunistic deals are really going to be the first to suffer. But interesting enough, like you said, everything's trading on a premium right now. It doesn't matter if it's falling down, you know, you're paying the same cap rate as you are as your new product. But like you said, the debt is becoming critical. And so, you know, we've subscribed to the thesis over the past, Brian, I don't know, 20, let's call it 18, 24 months that, you know, if there is a correction coming, like you said, if there is a reset coming, then you would rather be in a position of holding assets of higher quality versus, you know, these older buildings that have that deeper value add, that CapEx injection that's needed. Because if you can't refinance, you're screwed. You know?
And if you have low interest rate, fixed long-term debt, that becomes even more attractive if you are trying to sell, because now you have an attractive assumable loan. So not only is your building attractive, but so is your loan.
Exactly. Totally agree. Quality assets, long-term debt. That's the play for now, my opinion.
Mm-hmm. So in speaking then, going back to, again, new investor hearing this for the first time, looking to get started. I mean, you kind of have, I mean, most people have to cut their teeth on, you know, some of that value add product, right? Sure. And so how should they be positioning themselves and hedging themselves against that downside then to try to break into this market cycle? Because it's hard. I mean, you go try to get a, you know, like you said, you go try to buy the core plus assets. I mean, you're paying a premium and you're butting up against a lot of competition.
Yeah. Well, first off, I would say you need to network and probably find better investors or better investors that are willing to take a more lenient return. So it's all about the cost of capital. That's the real answer. Because that's when people ask me, they say, well, what is a good deal? I say, well, what is your cost of capital? Of course, they don't usually know what I'm asking, but what I'm saying is like, what do you have to pay for your money? Because a good deal is a deal that makes more money than you spend to own it. Real simple. A good deal is one that makes money. And so we have to kind of look at, well, what does our money cost? Well, 70, 80% is the interest rate of the bank. That's going up. And then the rest of it is that down payment or the equity coming from, investors. And so that's what you kind of have to look at your capital stack and say, what's my total cost? And that's where we're starting to thin out, is the cost is outrunning any of the profit. And I think that we are going to see that shift. Now, the K-shape, I was calling it a K-shape recovery, and I'd say we've recovered. So now I'm going to have to call it like a K-shape catastrophe or something. But yes, I do believe that we're going to see a split in the market. Now, let me say that is a personal fringe concept that I don't put in the mainstream of the world, and that's a Bill outlier concept. So I'm making that one completely up. But from a lot of experience, yeah, I think we're going to see hyperinflation in the A and the B markets, and that where the coin does actually split itself and land on heads and tails at the same time is by the market shifting into two different types of markets. And that's what I think we're going to see. And we've never seen in American history, but we're about to, where the A's and the B's become one type of market and affordable housing becomes a separate type of market, and that the factors are different for each, and the analysis and the valuations become very different for the two. That's what I'm thinking is going to occur. And so all the people that are worried about wealth preservation, tax write-offs, they're okay with long-term hold, appreciation, they're going to be fine. They're going to go to the A's and the B's. It's the investor that says, yeah, but I want to put in $25,000 and quit my job and live on passive income because you told me about value add. That's the one that's going to take a bath. And that's the C space. That's the affordable housing. And that's value add. And that's where I think that business model is going to collapse. And the reason that it's done so well and why the C space became so overinflated, which I believe the C space is overinflated. And for anybody listening, C space, I'm saying product built in the 1960s and 1970s, maybe very early 80s, your affordable housing apartments, physical obsolescence, they're getting too old. Their capital expense needs inside those buildings is going to override the current market valuation. And so everybody that's looking for wealth preservation is going to run into the A's and B's. Everybody that was chasing value add is going to struggle with that. And they used the term value add to go out and raise money in the C space. It's a sales pitch. I mean, I'm saying it's not a bad idea. It is. I've done a ton of value add, but that's a great way to raise private money. Value add, we're going to make a bunch of money on the exit, all this kind of stuff. Well, I think that's the market that's going to take a beating first. And it's because you're going to shift from value add to, holy cow, that property is just in really terrible shape. And it's not value add, it's value negative. And so basically what I'm saying is cost basis. What you buy the thing for, what you fix it up for, your all-in amount is going to actually exceed the market value when you start looking at plumbing, roofs, parking lot, all these things that have just been ignored for the last 20 years. And you're going to be the one that has to fix it. And that's where I think we're going to see a split in the market.
And the cost of your headache.
Yeah, brain damage. Yeah, it's going to go off the chart, which is fine. There's nothing wrong with older buildings. There's nothing wrong with doing CapEx as long as you pay the right price. See, there's the problem we have in the world today, is that you cannot buy these assets at the right price in order to bring the money into the building that the building needs and still make money. The only way that you're going to be able to fix the building up, make money, is with a significant price reduction in the initial purchase. Yeah, but your seller paid too much and you're trying to offer less than what they even owe on the mortgage. Oh, that's going to be an interesting market cycle. And that's when we're going to see fun stuff like creative financing. Funny, I wrote a book on that. It's called Creative Cash. It's on Amazon and Kindle. No, so point being, like literally, I think we're going to see a wave of creative financing that will help us deal with a lot of people that are over leveraged in older buildings. And that is why I wrote that book, Creative Cash. But that's what I think is going to be the solution over the next several years.
Yeah, it's going to be interesting to see how that plays out. And to your point about the value add model, I think, Brian, I know we've been vocal about this as well, right? That the value add play is essentially dead to some respect. I mean, these properties, they've just been slapping lipstick on a pig and then calling it,
hot potato.
Yeah, hot potato. But you can only do that for so long. And then we're now at that inflection point, which I agree with you, Bill, where a lot of people are going to be exposed. if they're not very careful. But
and then there's just the whole different, I don't want to go down a whole nother rabbit hole, but you're talking about value add and affordable housing. At what point do you do so much value add that it's no longer affordable?
Man, I've been screaming that, in my opinion. Yes, correct. Agreed. 100% agreed. A lot of times it is a really negative comment, but I feel like a lot of times value add is almost like mugging the tenants. These owners go in, they overpay for the building, and then they need some way to raise the rents in order to justify the purchase price. So they come into this affordable apartment complex, slam in granite countertops, Delta faucets, granite tile, all this kind of garbage, and then tell the tenant, now pay for it. Well, look, if that tenant wanted granite countertops and Delta faucets in a marble backsplash, they'd have moved into that apartment already. You know what I mean? They didn't. That's not real value to that individual in their life. And you've come in here and shoved it into that apartment, raised the rents, and that's not bringing value to that tenant. What would have brought value to that tenant would have been A, don't overpay for the building in the first place. B, manage it properly. C, do repairs, treat the tenants with respect, and make the unit affordable, and you will make a ton of money. It's all starts with that overpayment, and that's the problem, is people overpaying, and that's a gift that just keeps on giving. And you wind up shoving that all the way down to your customer base. Well, in affordable housing, that cannot work out for you if you over renovate, overpay, and then try and squeeze too much revenue out of an affordable tenant. And I think that's a model that we need to be careful with socially and economically going forward, and that those who abuse that model are probably going to lose money doing it. Now, that's not really a left or a right type comment, or a liberal or conservative comment. It's just math. It's just business. You can only choke your customers so far, then they leave, and I think that's what we're seeing going on right now. And so,
but Bill, I think you would also agree too, it's very market specific to some degree, right? Because every market is going to be different. A primary market like Houston is going to be very different than a tertiary market like Topeka, Kansas, or wherever. I don't know. It's not picking on people from Kansas, but you get the point. Because I guess my thought process behind that is, like, if you look at like what we're seeing in Houston, for example, the transactional volume across all asset classes, A all the way down to C, has been just phenomenal. I mean, I think we read a report last year, Q3 posted the highest amount of transactional volume on record for multifamily across the United States as a whole. So if everybody's coming in and buying,
good, by the way.
Okay, well, let's get into that in a second.
Yeah, but that's not good, but go ahead. We'll come back to that.
Yeah, come back to that for sure. So with everybody coming in and buying everything that's hitting the market, again, all of the C space, the value add space, and everybody's kind of implementing the same strategy, how do we, like you said, you don't want to choke out the residents, but really you're seeing this dynamic where they don't have any other option, because the next guy down the street just bought the next building and he's doing the same thing and same thing and same thing. So, I guess where's the stopping point?
And again, I wish we had about another couple hours to kind of go through all this. So we have to kind of take that point of view from the concept that we have a housing shortage. All right, so I'm going to make two controversial statements. We don't have a housing shortage. That's a nonsense concept. First comment. Second comment, what was I going to say? So the transaction volume, and that's not great, because that means this year and the next year, we're going to have very low transaction volume to equalize out. If everybody buys, see, that's the problem. It's not a used car. It's not a house. You can't flip multifamily every month or two. You wind up getting a loan. You wind up owning the asset for several years. And so if everybody just transacted last year, that's that many properties that won't transact for the next 2 or 3 years. So a high transaction volume of concentration means a leveling off in transactions going forward. So you're just agreeing with what I'm already saying is going to be a cooling off window. It's impossible not to, because we all just transacted last year to the highest level ever, cooling off. First comment. Second comment, be careful with this housing shortage thing. I think, and this probably irritate a lot of people, I think there is a housing shortage in America if we continue our lavish lifestyle. Go down to South America, go to India, go to Asia, and look how everyone else in the world lives, and look how we live, and tell me we're not being arrogant. What you're going to see is roommates. Tell me we have a housing shortage. Yeah, if every 18-year-old wants to move out of the house and get their own apartment, and everybody wants to have no roommates, we all want to have our own place. look, it's Brazil and places like that where those people are just stacked clean on top of each other, would love to live in the wealth and spread outness we have around here. If the tenants get impoverished, they will just move in with each other. All of a sudden, you're not going to be in a housing shortage then, are you? And that's a real possibility we need to be careful with. We keep with this attitude that these people have no choice, and therefore they're financial prisoners of ours on this property, and we can just raise the rents as we want. Careful, careful, careful. That is not true. They'll just start moving in with each other, and then all of a sudden you're going to have a vacancy problem. Yes, we have a housing shortage if we want to continue our arrogant lifestyle. If we actually tighten up our belt and live somewhat like the rest of the world, we might have plenty of housing. So be careful with that concept. I don't really think we have a housing shortage. I think we have a housing shortage as long as we want to maintain our very posh lifestyle that we enjoy as Americans. Yes, then we have a housing shortage.
Ooh. So, all right. So let's talk about that then. So you have this now, take the market dynamics for what they are, but now you also have a massive transfer of wealth and a massive demographic shift where now your millennial generations are the largest demographic in the United States, right? 72 million, 74 million, whatever it is. Yeah. They are your, first entry level home buyers. They're all your first time renters, things like that. What are you seeing from this demographic, the millennial demographic, as far as the type of housing that they're demanding or, their lifestyle that they're looking to live out?
Yeah, they seem to be later in life buyers of homes and renters. That definitely drives rental demand. Definitely does. So that all has to play into it. And to that point, if more people stay in the rental market and are not looking at the house on the corner with the white picket fence as the American dream, which that does seem to be kind of dialing down in the millennials and younger. Yeah, then that will depress house purchasing. The whole concept is population. That's the end of it. If the population continues to rise significantly, and it is, then yeah, you're going to lean more towards a housing shortage. Now, where I will turn the coin over again and completely reverse everything I just said, what will cause a housing shortage? The affordable housing getting too old, like I've already said. These buildings just getting uninhabitable. And if the cities and the code enforcement, and we're seeing this happen right now, come in and start really cracking down on these older buildings, and they're not building new affordable housing, yeah, you'll see a housing crunch in there. But we need to, that's what I'm kind of telling people: be careful about these older buildings, because you're going to run afoul of the city in a lot of cases. So that's an area that we could see a housing shortage, not in wealthier millennial demographic, but in our affordable housing space. And I do now think that there is somewhat of a housing, a shortage of quality, affordable housing in the affordable housing market. Is there a shortage of that? Yes. Is there a shortage of housing in America, period? No, I think that's a pretty arrogant comment. But yeah, I think good quality, affordable housing that is managed by responsible managers, there's a shortage of that. Yeah, definitely. But that's just my 2 cents on that subject. But yeah, I think still the C space is the rockiest area that we need to be careful about, the affordable housing.
Yeah, and to that point, I mean, the other dynamic here that is also creating that shortage to a point is the construction input cost, the development input cost, and development timelines are making it very hard to build affordable housing. And so, that's another interesting dynamic too. That's a real challenge.
Yeah, definitely. But we've talked about a lot of dramatic stuff on this call, and I do want to kind of circle back around, especially for people that are new and they're looking to get into the business. Look, it is kind of what I tell a lot of my students. You kind of, it's like you just jumped on a freight train going by full speed. The market has gone crazy a little bit. Don't think this is normal. The market will calm down. The market will level off. If you're new to this business, look, just focus on your education, study, read. It takes most students, by the way, if you're new, about 12 to 18 months to get their first deal. And that is in all market cycles, today, yesterday, and 10 years ago. It takes about a year for you to get going. And so what you want to do is really get in, start studying, listen to the guys like this, follow this podcast, get this kind of information, because in a year to 18 months, when you're starting to really get in and start picking up deal flow, we may be in a different environment. So you don't want to sit in the driveway waiting for all the lights to turn green before you back out. You can never time a market. There's only one other time it was better to get into the real estate market, and that was yesterday. You know what I mean? So just do it. Just get in. Don't worry about all the stuff we're talking about. Real estate always makes money over time, and you need to get an education so that you don't buy the wrong real estate. But if you learn how to buy the right real estate. A lot of what we've talked about on this call is just detail. It's not that relevant if you really know what you're doing. Real estate's multifamily is always a great place to be. So, and there are about to be a lot of opportunities coming. So please don't let all this conversation scare you off. But it's a good market.
Yeah, appreciate you highlighting that, Bill, because I think you're absolutely right. Right now is a perfect time to take advantage of getting educated and just literally kind of understanding the dynamics of the market so you could be well positioned. And I'm going to put back on the screen here, Bill's book, Real Estate Raw, for anybody looking to get started, a step-by-step instruction manual to building a real estate portfolio from start to finish, available on Amazon and Kindle. So,
and I should put it in there, in any market cycle. I should added that in the subtitle, in any cycle.
Yeah. Well, I just got this delivered the other day. Bill, I got to be honest, I haven't got to dig into it yet, but I'm looking, like I said, I was looking through, the index here, and I mean, this thing is just jam-packed, nuts to bolts, start to finish, on how to develop an infrastructure on a scalable, sustainable portfolio. So kudos, man. I can't wait to dive into this.
Yeah, it starts off as if you really don't know much about real estate, it starts you off small and works you all the way up to a commercial portfolio over time. So the book starts off assuming small assets, and then it works up larger as you go through.
So let's talk about that, Bill. So then for those who are listening for the first time right now, whether you're active or passive, education is obviously key and most important. Where should investors right now be focusing their efforts in trying to build their business?
Well, again, it would depend on education is the answer. And it would really depend on which side of the business we're talking about. So if we're talking about active investors, and we'll call them GPs, LPs, right? The general partner group, the people that are trying to go out, buy real estate, syndicate, make money, make this a business. Obviously focus on your education, but right now your efforts need to be in deal flow. Deal flow. You really need to be focused on deal flow. You need to be analyzing 3 to 5 deals a week. And I know that's tough right now because inventory is low. So what you're probably going to want to do is expand your territory. So what I teach my students is you need to be analyzing, a minimum of 3 deals a week. So you've got to kind of pick a market don't even think about markets being cities anymore. Let's talk about, when we say market, we want to think regional area. And your market area is the area that you can source 3 to 5 deals out of every week. So as the inventory shrinks, then your territory increases, and if you can go find 3 to 4 deals in your backyard, then you have a very small territory. Great. Just adjust your market size based on getting at least 3 deals a week. So that's one thing I'm telling the general partners. If you're a limited partner, you're looking to invest passively in someone like myself or these gentlemen or someone else that's out there, you really got to understand some basics of deal analysis. Know, like, and trust is not good enough. And that's what everybody seems to invest in. I know, like, and trust, Bill. Great, fine. I'm happy for you. But I'd really feel a lot more comfortable if you actually knew a little bit about that deal and the information I'm giving you. You could actually vet some of my data. I'd be a lot more comfortable with you as an investor if I thought you had a little more information here than just know, like, and trust. So as a limited partner, you're going to want to learn to take a class, get somebody to show you how to some basic underwriting. Call me, I'll help you out, anything. So that when a syndicator brings you a deal, you don't have to just know, like, and trust. You can actually verify some of the information they're giving you because they may be wrong. They may be good people. They're just making a mistake. So those are the two kind of points of view. I see most limited partners that are looking to invest in real estate can't analyze their way out of a wet paper bag, but yet they're willing to, write $100,000 check to somebody. Don't do that. All right. And syndicators, it's all about finding those good deals. You're going to have to get out and really hustle, grind, and get the deal flow going.
And that, ladies and gentlemen, is why Bill Ham is the master coach. Boom, bringing the heat as always, Bill. Love it. Well, I agree with you. I know Brian as well, man. I wish we could spend a couple more hours just going through this because, there's just so much to unravel here. A lot of great conversation. Always appreciate your insights, Bill.
Thank you.
Before we go, let's go ahead and ask a final 4 questions here, and then we'll kind of wrap up here. So, I think we asked this last time, but what are you doing to continue your own education to further your investing?
Teach and hire coaches. I have coaches, and that's a conversation that I probably haven't talked about a lot lately. Somebody the other day asked me, they're like, well, do you have coaches? And I'm like, yeah, I've got all kinds of coaches for everything I want to go learn. My answer is hire a coach. I'm lazy. I don't want to go. I'm old and lazy. I don't want to sit here and try and go through the learning curve and stuff anymore. I want to, what if I want to go trade crypto? Man, I'm hiring a coach. What if I want to go stocks or whatever the other thing? Hire a coach. Any hobby that I have, I hire a coach. So I love coaches. I'm always looking to hire someone to teach me something. So that's what I do for my own personal continuing education. And then teaching really helps you stay current. And so the more I teach, the more deals I look at, the more exposure to the market that I have. So I look at dozens of deals every week through all of my students all around the country. So that really helps me keep a pace of what's going on in the market. And then reading, just really paying attention to economic trends. I read the Wall Street Journal every morning, except Sunday. And, so really paying attention to global trends, politics, economics, things like that, what's going on in the world, and then kind of gleaning all of it together. That's how I stay ahead. And that's what I do for my own personal education.
Awesome, man. Awesome. All right, Bill. So looking forward to 2022, what are you most excited about in the multifamily space?
In the multifamily space. Yeah, I'm looking for the creative financing to start kicking back up. I'm looking for a market where I believe operators and people who kind of already know what they're doing are going to get their day. That it's been the speculator market over the last few years, and it's going to turn into an operator market. So again, I'm strongly recommending people kind of start to learn the basics of management. Not suggesting you go be a property manager, but I am suggesting that you learn asset management at a minimum. Again, a subject I teach and can help people with, but asset management at a minimum, and touch on some property management, because operations are going to be the key survival method going forward over the next couple of years, especially if we hit some rough patches in the economy.
Sounds familiar, huh, Brian? All right, Bill. Well, I know we kind of talked a lot about where investors should be starting or focusing their efforts on right now, but one piece of advice you'd give the listeners to help them grow their businesses.
Network. That's the number one mistake I've made in my life, is not knowing enough people, and it's the one thing that would have solved all of my problems in any market cycle. If I had enough money, if I had enough people willing to do business with me, I would not have had any of the problems I ever had. So I would say networking relationships will solve most of your problems. I won't say all, but a fair amount of them, so meet more people. That's what I would recommend.
Well, we say who, not how.
Yeah, right. There you go. Exactly.
That's all right. That's right. All right, Bill, we'll tell the audience how they can learn more about you and get connected with you.
Absolutely. First of all, check out my website, Real Estate Raw, same name as the book there. I've got some free videos on there. I've got a free course on how to get started in real estate, and I've got some other courses you can take online there. But I would say go on realestateraw.com and at least download the free course. That will put you in our system. And as I bring out more information and other events and things I'm doing, you'll be notified going forward. So that's number one. The books are on Amazon, Creative Cash, Real Estate Raw. They're both on Amazon and Kindle. And then my email, bill@gobroadwell.com. And Broadwell is BROADWELL. So just send me an email, bill@gobroadwell.com. Love to hear from you.
Bill, thank you as always, man. Always appreciate your time. Looking forward to the next one.
Take care, guys. Bill.